Hello, and welcome to this week's installment of Nucleus Investment Insights. My name is Mark, and I'll be hosting today's webinar. Today, our topic of discussion is wage growth and will it cause inflationary growth and boost economic recovery? Our guests today to discuss this further are David Llewellyn Smith, Chief Strategist at Nucleus Wealth, and Damien Klassen, Head of Investments at Nucleus Wealth. Before I hand over to you gentlemen, a quick housekeeping message. A reminder before we get started, if you haven't already done so, please do subscribe to our YouTube channel and click the notification bell to be notified when we go live or have a new webinar to watch. Or alternatively, follow us on your preferred podcast platform. For those listening in live, feel free to drop in your questions in the YouTube live stream and have them answered along the way. Over to you, gentlemen.
Thanks, Mark. So I think the main thing what we wanted to do today is really sort of dig into the wage growth issue. So we had some wage growth figures out from Australia just yesterday, and they sort of came through showing that there was certainly some recovery in wage growth, but it's a recovery to a very low level. It's off the bottom, but it's not that far off the bottom. That's changed. That's a bit different to what we're seeing overseas, but the main thing we want to try and come back to is, there's this specter of inflation, and will inflation take off? And for me, the party is saying, well, inflation will only take off if wage growth becomes entrenched. And we're not talking about wage growth, which is this initial bounce off of very low levels or recovery from the depths of the pandemic, but actually real genuine wage growth that's going to continue. And we're not seeing real signs of that. So we wanted to really dig in and sort of go bit by bit through each of the concepts. And so digging into where we've come from the last decade, because I think that's quite instructive as to what we've seen in terms of wage growth, looking sort of around the world at what's helping elsewhere, and then structural changes within the wages market itself. So, and before finally getting back to that whole investment implications and what does it actually mean for the portfolios that we're running at Nucleus, and what does it actually, what's it going to do in terms of those, what are the effects for end investors? So I might jump to that first slide. I might let you do this one, David. A decade of broken dreams, the RBA's famous wage price index forecasts.
Yes, well, this is what happens to you when you have a glass half full view of the world. But, economics isn't called the dismal science for nothing, and the RBA got far too happy over the last decade in all of its forecasting. And here we have a chart that shows just how poor that forecasting was when it came to wage prices, which of course flowed pretty directly through to inflation as well. So it was a pretty embarrassing decade for the RBA, and if anything, just as bad at the Treasury with its budget forecasts. They were equally hopeless. Now Australia,
and actually, so just describe this chart just quickly for anyone. So this,
sure. Well, we've got all the RBA forecasts here in different colours, little lines coming off a declining wage price index for forecasting for the year ahead. And each time it was a bottom and a kind of hockey stick recovery for 1, 2, 3, 4, 5, 6, 7, 8 or so. I mean, they got it right 1 out of 8, something like that, over 8 years. Now we're going to go through all these various wage issues one by one, but just a little bit of the Australian market is a little bit idiosyncratic insofar as immigration has played a very strong role here, where not necessarily elsewhere, although in some of the other Anglo countries that is true to a lesser extent. There were 2 big factors in Australia's great wage deflation over the last 10 years. The first was the big mining crash after 2011, which hammered our terms of trade. And this is going to be very important looking forward, because we're about to go through we are going through something very similar right now. And what that does is slash your national income when your terms of trade fall. And as a result, it's like basically the economy is getting a pay cut. And when it's such a large slice of your exports, as in the case of commodities for Australia, that tends to filter down into just about every price in the economy eventually, but especially wages, because as income falls across the nation, business profits start to fall, margins fall, unemployment starts to rise, nominal growth falls very quickly, and so you just get wage pressures, downward pressures. So that was the initial problem that hit Australian wages from 2011 onwards. But what happened after that is we really stuffed up the policy response to that, and instead of slashing interest rates really hard, getting the dollar way down, and working on a tradable recovery that would have substituted that export income, we opened the floodgates on immigration instead, and as a result, we in effect imported just masses of cheap labour. We kind of deregulated the visa system and ended up with just heaps and heaps of unskilled cheap labour, and that triggered some growth in other areas, in real estate and other places where you were creating kind of artificial shortages by growing your population. But at the same time, it absolutely hammered wages again, because you simply had a permanent supply shock of cheap labour coming into Australia. So those two factors played a major role in what has become an absolutely historic period of low wage growth in Australia. We haven't seen this for a very long time.
And keep in mind, these are real. Sorry, not real. These are nominal figures. So these aren't adjusted for inflation. So if you adjust for inflation, you're basically at zero.
Yes, you are. And probably the takeout from those two factors looking forward, and we will come back to this, and we're going to look at this more broadly, of course, is that we are going through a very similar terms of trade crash now as we did in 2011. Iron ore is getting slaughtered. It's got a lot further to go. The coals are going to follow. And so we're going to see this big income shock going into next year. And we're going to see a reopening into COVID as the nation is vaccinated. And both political parties want to resume exactly the same bad policy as last time during terms of trade shock, and that is a resumption of mass immigration. And so you can expect wage deflation in Australia to be a permanent state as long as those settings are in place.
Having said that as well, I guess to the RBA's credit, they're actually publishing this chart. Like, it's often, it would be easy to hide it away and pretend it never happened.
Oh, I mean, he's paid $1 million to be transparent,
Yeah,
that's fair enough. But I mean, also to the RBA's eventual credit, they did, after many years of denying it, finally came out this year and said, yes, immigration played a key role in suppressing wages. And you can argue that the kind of politically correct blinkers that the RBA had on during that period, where they felt they couldn't raise immigration as an issue owing to the constraints of what was defined as civilized discussion by the press, blinded them to what was happening. And now, as COVID has kind of shaken everything up and thrown all the cards in the air, they're more liberated and being a little more honest about the drivers. And so they are actually fighting, in effect, fighting against a resumption of immigration for Australia, the RBA, because they want to see wages rise, quite rightly. But they're going to get steamrolled by political parties that have no better idea and are owned by the interests that benefit from the immigration. So.
Yeah, but I guess so. It'd be interesting to see where they get steamrolled. I guess at least there's a whole cohort of economic journalists out there who largely take their lead from the RBA.
Yeah.
So at least they will be chipping away at the idea, or they've started.
They will, and I don't think it'll be quite as bad, I should say, unless, well, let me leaven that. It probably won't be quite as bad under Labor. They plan to at least re-regulate some of the visas in the short-term worker stuff. but they're still very committed to very high permanent migration. So they'll only be marginally different to the coalition. But if the coalition is in, their recent Senate discussion of or study into immigration was deregulate the lot, just open slather. So it will be worse if the coalition gets it.
Maybe we can jump quickly to wages around the world. So I've got some UK and some US charts. UK on the left and the US chart on the right, and they're both showing. Well, actually, I'll do the US first because it's the one on the right. So it's sort of it's got the big drop from 2008, and then this huge rise up through to 2020 with the Trump tax cuts and lower and lower unemployment. A bit of a drop off, but now a sudden spike up again. So wages there are actually looking pretty strong within the US, and then within the UK, that one's got a few adjustments for some of the government factors. But there's a blue line there, which is sort of showing that again has, even if you exclude all the effects of the money that's been paid, you are getting some quite reasonable growth in terms of in terms of wage growth in both the UK and the US, sort of back to pre-COVID levels at least. And 3.5% is a pretty reasonable. If you're running inflation of 2% and you're getting 1 or 2% above that, is not a bad sort of feel for a longer term. So that's sort of at the big picture. The thing is, though, when you take a step into that and see where the wage growth has come from, and that's these next slides we've got up there. We've got one just showing how leisure and hospitality, the average pay has really shot up within that industry since it's this is within the US for non-managers, $15 an hour just before the crisis to now 10% above that now. Following the pandemic. And then another one that's just tracking together that same type of idea is what's on one axis. It's got the low growth. It's got the average hourly rate, which is along the bottom x-axis, and then it's looking at the change over the last couple of months, and you can see that basically low. It's the lower income people who have had this big jump is one part, but it's also the ones that have been the most insecure because of this. So I guess there's the question sort of comes back to, are we seeing genuine wage growth here, or is this, I guess, a reflection for if you're going to be a waiter, is that you can get locked down and left at home and have no money and no, without any support. Most of these are sort of casual roles. Well, that means you're going to need more money, or you'll be looking. There'll be a lot of waiters trying to get jobs as, I don't know, as cleaners or as other things that have got more secure and stable income. And so basically the leisure and hospitality, because they're the most affected by these shutdowns, maybe that means they just actually need to pay a lot more to their workers just to get them there. But that it'll be that's sort of a bit of a one-off adjustment, and potentially that will even fade over time if we start going through long periods without shutdowns. As maybe that's people will forget about it and start accepting whatever wage they can to get work.
There's probably some COVID distortions in here as well that will work out over time. The borders are all shut, international borders, so not a lot of travellers. For leisure and hospitality, although I'm assuming they can work in the US. I actually don't know if they can. But aside from that, still got quite a lot of COVID caution in people going back to work in the US.
Well, that's one of the latest slides. We might jump to that in a minute. So maybe
in the blue states, lingering unemployment benefits. From the pandemic, extra unemployment benefits. So in short, I would expect participation to rise as those things wane.
Yeah, well, let's jump into some of those and have a look at what's been going on with those. So I've got the next one I've got is this what's called a beverage curve. And so basically what it is, there's three lines in this graph. all sort of running from in a sort of 45-degree angle, and each one's a little bit higher. And what it's tracking is it's tracking the unemployment versus the number of vacancies, job vacancies out there. And so the idea is that, well, when unemployment gets low, you actually get a lot more job vacancies because it's harder and harder for people to find employees, sorry, and so they need to advertise more to get out and find people. Whereas when unemployment's really high, you don't actually need to run very many job ads because you run one job ad and you get a whole bunch of people all looking for work. And what's really noticeable about this is that when you go through structural change, that curve sort of jumps, and that's why I've sort of I've put it as 3 lines. And so the light blue section at the bottom is where it was running up and down this line sort of prior to the financial crisis. The financial crisis happens, and you get this big jump up to the right, where all of a sudden you've got all these builders and real estate agents and mortgage brokers and people like that who now need a new job because they don't have the work they used to do. And so you get this structural change, and then gradually that structural change comes out of the economy. And arguably, just as the pandemic was hitting, we were actually back to a more normal, that orange line was right at the top of it as it was starting to come down is where we were, which looks like it's probably back on track with that blue line again. And so, and then the pandemic hit, and now we're just like completely off the scale. But the problem with this is, it's either one of 2 signs. Is there's either like a radical amount of structural change that's needed to be made to the economy, which to some extent, there's certain truth to that in a certain extent, but there's also this part about there's this temporary dislocation of there's a bunch of service workers who haven't been able to work, and we've had this big boom in manufacturing, and so you've got to convince your service workers to go work in manufacturing, and now as the service sectors are opening up again, they need to convince people to come back and work for them again. So there's actually a lot of it's I guess the inherent frictions in the job market that actually make it quite difficult. So I guess what I'd be saying, I guess to put it another way, is if you saw this, if you saw the level of job ads that are out there at the moment, which is sort of 7%ish, and you map that back to that blue line, you'd probably expect to see unemployment of maybe 2%. But we've got maybe 3 times that unemployment. And so I guess one of the key questions nobody knows the answer to, but it's how much of this is just temporary and how much of this is actually a genuine structural change that will actually just take a long time to wash through versus and I think there's probably, to me, it's probably a mix. I think there's probably quite a fast recovery as you start to open up, and then but there will be some underlying structural changes that will you're not going to go back to that light blue line. You're probably going to go back to something closer to the orange one for maybe another decade until you get back to something more normal. Dave?
Yeah.
On board with that one?
Yeah.
Okay, and that brings us back to what Dave was talking about. Was the other part is this participation rate. And so I've got another couple of slides just sort of showing US participation rate, and I've split it into 3 different categories, or on here I've got 3 different versions. On the left, we've got the 55s and overs, because the problem you often find in recessions is that when a recession happens, people retire early and they never come back to the workforce. And so the question with that is there a chunk of those people now who are actually not going to come back? And then on the right, you can see that there's 2 different ones, the 25 to 54s, which is where you've seen most of the jump back towards getting back to a more similar level. But there actually hasn't been much recovery in the 16, 16 plus. So there's sort of like that 3 areas of the market. And there is a genuine question about, in terms of unemployment's quite low, but unemployment is low because there's actually a lot of people that are just no longer part of the workforce. Dave?
Yeah, I'm just curious why youth is so low. Any ideas? I mean, especially given the carrot of the rising wages in in sort of entry level employment like leisure and hospitality, etc.
Yeah,
Well,
don't know.
David, in the Australian context, it could be the fact that a casual worker was working maybe 3 or 4 or 5 hours a week is now getting paid or was getting paid. Job seeker, which was roughly $600 a week,
Hmm. Well,
or
that's just,
four or five times what they were actually earning. So the question is,
Mm.
why?
yeah. Well, let's go to
Well,
the next slide.
yeah.
Yeah,
Hmm.
because I think there's a little bit of the answer behind this. Is he right? There's a lot of people out there who don't want to work. And so this is we've got a survey that Indeed did of people around the world, and I've broken out the US versus the Australian ones. And so and this was around. So there's a bunch of people out there who are vaguely looking for work but not urgently. I can't remember exactly how the survey was, but it's basically trying to go to those people and say, well, why aren't you urgently looking for work? And in the US, the most important reason was fears of COVID. So they didn't want to go out and get sick. And the least important was actually getting unemployment benefits. Was like, so I guess the answer there is, look, I'm getting unemployment benefits. I don't really need to go out and work. Whereas if you look at Australia, it's the most important was that they were getting the job seeker and welfare payments. Now this was only up to July, so that's obviously fading off, and there's there's issues there. But yeah, it is interesting that's that one part. I mean, carer responsibilities is another big part. Sort of almost 20% of people are basically saying, well, and it's probably a mixture of that and the spouse employed as well. If the kids are at home and or they're going to be back and forth in and out of lockdowns, and there's a lot of home schooling needed to be done, then maybe it's just not worth going out and looking for a job urgently, especially if you've got a spouse who is already working. There's that whole mix. But there's clearly is, um, the unemployment numbers, while they've come down, I think there is a certain amount of that which is not real in terms of once you clear out of the COVID, then there is another group of people to come back. And so the question is now, do you get this short-term sort of wage spike while employers are trying to put their wages up, trying to attract these people back to the workforce, but at some stage you actually do get a flood of these people come back to the workforce, and then the wages then weakens off again. I don't know, Dave, your thoughts on?
Yeah, I mean, I think basically what I think is all of those things are going to happen. Like it's a sort of transitional phase between pandemic to endemic, if you like, where we've gone from protecting communities, having lockdowns and stimulus, to accepting the virus, being vaccinated enough, and everybody just eventually catches COVID and lives with it, and the mortality rate is like the flu, more or less.
If you're vaccinated.
If you're vaccinated, yes, crucially.
Yes.
And so that's not going to happen suddenly. And so what all of these things that you're describing are going to, I guess, be in tension over 2022, as whatever as we transition from that one regime of pandemic to the endemic regime. And so I suppose I would guess, we're probably likely to see pretty decent wages growth in the US. I would have thought persist, but but probably come peak and kind of grind sideways over next year, perhaps. Here, I wish it was so good. Here, I think we're in real trouble. I don't know what's going to happen to wages here, but it's nothing good. And then worldwide, probably similar. I mean, I really think that this will be a long transition, not the V-shaped recovery that we had previously. More of a swoosh shape, I suppose, where or an upside down swoosh, I guess, where you've had a peak and it'll kind of slowly come off. But then in the US, at a certain point next year, you probably are getting to a relatively tight labour market later in the year, especially as the big Biden, the new wave of big Biden stimulus starts to come through and adds, 0.5% to GDP for 5 years. Then pushing into 2023, you might get some stronger wage growth again. So I think the outlook for wages in the US is okay. It's pretty good. Like, I think they've got their policy settings reasonably good, but I'm not still not overly concerned about a runaway wages cycle, because this is kind of pushing into so many structural headwinds for wages growth that, as we're seeing right now, the moment there's any kind of tightening from monetary policy or fiscal, markets start to hiccup rather badly, and you start to get some very heavy deflationary forces pushing down. So, it looks like a decent wages cycle over the next year or two for the US, but perhaps fragile nonetheless. Further out as things normalise, I would expect it to be pretty good.
Yeah, in terms of the Aussie, it's look at the next one, sort of showing some expectations from unions, market economists, and households, and it's quite interesting to see that households are not confident at all.
No,
in terms of wage growth.
I mean, households, ones living in the nominal economy, aren't they? The ones that understand it best. Market economists are a pack of muppets for the most part. Unions,
present company accepted.
I'm a market strategist.
So you're going to leap, are you?
So, and unions, you would expect them to always be pushing for higher wage growth. So I think households have got it right. I think the outlook's pretty gloomy for Australia for the reasons we've already described.
Bit bearish for less than 1%, but yeah,
yes, maybe so. Well, I don't know. I mean, we are really entering a very, very tough income period for the economy. Once you add terms of trade crash to the endemic COVID caution transition, that's a pretty sluggish economy.
Yeah. Next one, I just want to raise this question as well.
David, just a quick question to both of you. The RBA seems to be focusing more on supporting the housing market to try and stabilize the overall economy. How do you think that's going to affect, or does it affect at all, wage growth and what we've been discussing up till now?
Well, I mean, the RBA will never admit that it's interested in house prices. It will only ever talk about inflation and wages and other macroeconomic prices. But, of course, it is obsessed with house prices. And as we see the endemic COVID transition, which will make things difficult, hit by the terms of trade shock, which will make things really tough, then the RBA will be confronted with falling inflation and wages, and it will. Well, I wrote yesterday, it may have to go negative interest rates. It'll certainly be printing more to buy more government debt, but I think the prospect of it attempting to lower real mortgage rates is very real, and it'll do that by restoring the term funding facility. It may not go negative with that yet, but if it starts giving the banks money at zero, for instance, then that would be deliberately targeting mortgage rates, and it would never say it was trying to lift house prices, but that is what it's doing in effect. So I think that's
the only weapon left.
I think that's yes. I think the RBA. That's exactly right. I think the RBA is naked and afraid, and it will use the only weapon it has left. So yes.
Yeah.
We have a question here from Lily who says, where does working from home and not needing the increase in wages to cover your commute and city living expenses, etc. So
Yeah.
does it affect? I mean, you're not commuting
Abs-
so as much. You're not spending as much in your
well,
petrol, blah blah blah.
I think for maybe for household budgets, there's some sort of help within that. I guess the bigger issue for me is you now have a whole world of competitors. If you can work from home, then somebody can do your job from a regional city where they might need a lot less in terms of wages. And then the second part is quite possibly somebody can do your job from Manila or from India somewhere, or pick a country that's with much lower wages than Australia. So it might not mean that the people lose their jobs, but it probably means that getting wage rises is going to be a lot more difficult because you've got that factor of I can't go and ask for a 10% wage rise where they can see that they could turn around and outsource my job to a different country and save themselves 30%. So might not be enough to be fired, but it's enough to keep that real lid on wages from that perspective.
And just so you know, Damien, this has been recorded. It will come back appraisal time.
Yeah, that's right. when that's right. There's a I'm in the fortunate position of being an equity owner here. I might be saying that to you, Mark.
I didn't say anything.
The next one, just talking about this spare capacity part. So this used to be the sort of the whole driving of economic models was that if there's spare capacity in the market, then you could have wage growth. Or if you didn't have enough spare capacity and you had this NAIRU, which is I can never remember what it is, but non-repeating, but basically where the unemployment level where you don't get inflation from. And so that was sort of the basis of most of these models, and most of the ones that ran sort of the RBA ones that generated those results. I don't know, Dave, is spare capacity, is it enough anymore? And maybe the part I'd posit is, for a lot of this spare capacity, because we're doing a lot more trading than what we used to, spare capacity is a bit of a global factor now, as much as it is a local factor.
Yes, and this comes down to immigration as well. I mean, you have limitless spare capacity if you have a large enough immigration program. But yeah, I think capacity still matters. It's just that the NAIRU is kind of perpetually falling. I mean, the RBA has it. I don't know why it says 5% on that chart. They're more at 4% now, and it's been falling non-stop for decades.
And we know the US are talking more like 3.
Yes, well, we did almost 3 in the last cycle, and we only got to sort of 3.5% wages. So again, yes, it matters, but there are so many other kind of headwinds to wages growth that it doesn't seem to matter the way it once did. So, I don't expect a wages explosion just because capacity is starting to get limited. But if you can drive unemployment to 3%, then you will get better wage growth. Yeah.
The other one,
that ain't coming here.
No. Well, we'll go into a few of those. Well, I've just got one more chart I wanted to show quickly, which was from yesterday's labour price index, which is showing that this private sector versus public sector idea, and you can very much see there that the public sector is as low as it's ever been, and so it's a little bit of a discontinuity, and the RBA itself has been out there exhorting people to get wage price growth, and then turning around to its own unionised workforce and only putting through very low wage rises. And the government's in exactly the same position. So I guess the question I've got maybe for you, David, is can we actually grow private sector wages at a decent clip if we're trying to shrink public sector wages at the same time?
Well, obviously it doesn't help. I mean, we'd probably differ a bit with Leith on this one, just insofar as it can be frustrating watching bureaucrats get fat pay rises, and most of them probably don't deserve it, although I don't want to be too stereotypical.
No.
But it is true that
Any of our regulators definitely deserve it.
Yes, that's
Yes,
right.
if they're listening in, yes.
Yes, and if they have super. So, no. But 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 yes, I mean it's all they're components of the same market. So
Yes, exactly.
if you're going to squash one, it's going to impact spill over into the other. So
Mm,
so no, it
yes.
doesn't help.
Yeah, and yeah, that's right. So by keeping the public sector wages moving along and ticking along, that offers an alternative employment situation for people. And usually, the trade-off is you get a lower wage in public sector, but you get a lot more stability. And so if the wage turns from a 10-15% discount to a 20 or 30% discount, then that often will just mean that the private sector then can just keep its wages down. So I think there's a fair bit of cognitive dissonance, I think, from governments who are trying to get wages up, and at the same time keeping the wages of their own employees as low as possible, and that includes the RBA.
Yes, I mean they're
So,
specialists at government at cognitive dissonance.
yes, yes. So some of the other factors, and as I said, there's this long list of these other factors that are sort of driving it. So I started with government support, just in the view that we've seen over the last year a lot of job keepers and job seekers, and every other country's had its own version of that. I think there's a short-term issue, which is we are seeing Delta outbreaks around the world. We are seeing, though, that vaccinated populations are dealing with it relatively well. But there is a key factor is if there is more government support, then that's going to drive wages higher. The net, and whether it's substitution from private people paying it out to government. But I think probably the biggest factor for wages is whether government support comes back or if it disappears. And I think the more government support you get, the stronger the wage growth we'll see. But if it's going the way it's the moment, which is government support's being withdrawn, then that's obviously going to end up with lower wages. Immigration we spoke about. I don't know if there's anything else on immigration you wanted to talk. You could spend a whole podcast on that, couldn't you?
Yes. Well, no, it's just the case that it remains a universal policy commitment in Canberra,
Mm.
and as mentioned, some of the other mechanisms of government, especially the RBA, are starting to campaign against it. But it's such a simple lever for government to pull to artificially boost GDP, which is, of course, their artificial metric for performance. And they don't look at GDP per capita, which it obviously affects badly, because you're slowing the growth of the pie while cutting it between more people. And the alternative growth path is productivity-based reform, which is much more difficult to do. Takes real kind of policy process planning and communication skills, all of which are completely absent from Canberra.
Yeah.
And
Well,
so
and you don't get paid as well by donors. You don't have donors out there who are
that's
saying,
right.
yeah,
And you have many rentier corporations now fastened to immigration. So it means that the great likelihood is that it will return. And if you put that into what we're looking at with a slow COVID transition and in terms of trade crash, then it means Australian wages are in for another lost decade.
Reopening timing differences is another one. So countries that open faster and are more vaccinated will be more likely to see wages bounce back earlier. I think Australia probably sitting pretty close to the end of certainly the developed world in terms of that spectrum.
Probably, I think we'll have, I suppose, in behavioural economics terms, probably the worst transition, because we've been so protected. And so you would expect that as the virus spreads in the country, that there will be a lot more caution here than elsewhere, slowing the rebound once we do open, even assuming vax rates at 70 or 80%. I think just that the fact that we've been in cotton wool for 2 years will mean just hesitancy will be quite high about getting back to normal. So I think that's another one weighing on Australian activity.
State border controls. Are we going to? Is New South Wales
Well,
going to be?
well, this is really
blocked off from the rest
interesting.
of
I
it?
mean, this is where you get to COVID apartheid, and look, I think by say Q1 next year, vax rates are at 70, 80 in Victoria and New South Wales, and they're both kind of transitioning away from lockdowns. But then WA, you know, talk about cotton wool, like they're a long way behind on their vax rate as well. They have a premier dedicated to zero cases. I mean, at a certain point, they're going to have to open their borders, but will that be even later? And if it is, then those borders will get stronger, not weaker, as other areas woke up. Yes, it's another headwind. Again, another difficulty in the transition between pandemic and endemic.
Yeah,
Yep.
that you're not seeing elsewhere because
Yes.
different states, say within the US or different areas within France or Germany, might have different plans for it. But the reality is they're all still open to each other, and they're all none of them are at zero, so that they don't have that issue of one state not at zero and the rest at aiming for zero.
Yep.
So we spoke about the growth hole. So China, and so we spoke about that a couple of times over the last few weeks, but certainly slowdown in China only seems to be gaining momentum in terms of no signs that they're going to reverse course yet. So for Australia, that means a lot weaker growth again within Australian wages relative to offshore, but it's probably a dampener on all wages globally.
Yes, I mean that's a deflationary pulse. That one of the things that I expect to come through and pull down inflation worldwide. It does look like China is still dedicated to reform in this period. We will see more a slow turning, an oil tanker turning in the towards stimulus, but it is slow, and it looks like it'll. My guess is it'll be more monetary than fiscal this time around, which presents its own problems. But the key takeout from that is what we're seeing today: commodities prices getting smashed, and I expect that to spread. It's already pretty lively in oil and obviously iron ore, but I expect it to spread through the entire energy complex and base metals. And so that represents a very strong deflationary headwind for 2022 for the global economy, and then obviously that in turn impacts potential wage growth when you get low inflation like that.
Tax rates. So, I mean, my take on tax rates is, if you're seeing falling tax rates, that often just means that companies don't need to increase wages as much. I guess the idea is that as long as people's take-home salary is increasing, then people look upon that as a positive thing. And so we still have sort of tax cuts coming through in terms of the Australian government. So I guess my thoughts are that probably means slightly weaker wage growth in its own right.
Yeah, and inequality. Yep. Like these things just suck away aggregate demand.
Yep.
So
yeah, that's right.
You push away from that high capacity utilization that gives you the wages growth, makes it more difficult.
Yeah, and it's what we've seen exactly from coronavirus is when you hand out money to all the poor people, then they go out and spend it as fast as they can. But if we see that asset prices keep increasing, so we keep seeing lower interest rates, asset prices going up, and wages stagnating, then that actually feeds into less demand for goods, which then feeds into lower wages again. And so it's sort of a bit of a cyclical, pushing in one direction. At some stage, it'll unravel in the other direction, but it isn't looking like going that way anytime soon.
No, I mean the one place where that may transpire over this cycle later in the cycle is the US. Again, coming back to the Biden stimulus, where they are doing the right thing with a heavy fiscal investment program, and that is clearly targeting inequality, and that will work against these things. And so, one of the that's one of the reasons why we're kind of bullish on the US dollar for the cycle ahead, because we
And
think
then
their wages growth and inflation impulse will be stronger than elsewhere, not necessarily tear away, but stronger.
and then the work from home stuff we had that question from Lily a little bit earlier that sort of we covered off largely on that one.
Yep.
So that's pretty much it for the wages side. So so I guess the net effect is we are expecting to see wages. We expect to see some short-term upward pressures, but as David spoke, that whole swoosh idea that fades away, and that there's these deflationary factors sort of pushing down on wages, for the foreseeable future. You need policies like you're seeing in the US to try and combat that inequality. Whether the US has enough of it or not is an interesting question. And
Well, you're trying to reverse 30 years of this, so it's obviously not going to be enough. But it's a start. They have made a
yes,
start, which is, better
better than
than
what we're doing here.
what we're doing here. Yeah. Yep.
Yes. So what that means for us is that we're quite conservative at the moment. We've got these growth scare we've been speaking about for the last 2 weeks. Over the last couple of days has really started to hit the markets, and so for us it's a matter about holding back, keeping on with the sort of quality growth end of stocks, not really in value stocks. We're looking for this Aussie dollar lower and this income shock, which means more assets in international markets and less in Aussie markets. And now it's a matter of reactions and looking at what government reactions and central bank reactions are going to be. So the RBA has already said it's working back towards loosening, and the longer we are in lockdown, the more likely we are to see them reverse case. Hard to see what's happening on the government end at the moment. So we're, I guess, watching for the government pressures or government reactions to the lockdowns in terms of more stimulus within Australia. Internationally, it's more about the Fed is basically taking the other side of that bet and talking about tapering. We suspect they probably won't get there, but if they do start to taper, that's just going to increase that possible downside. And so,
if they do get there, they'll be reversing shortly afterwards.
Yeah. So I guess the investment implications is really we're still in a market driven by central banks and Feds. We think they're being they're tightening too quickly and removing support too quickly, which means there is this bit of a growth scare. China's certainly slowing down, and so that means what we're really watching for now is what we're really looking for is keeping assets secure and minimizing downside with a view to then having some dry powder to step in either when we see enough government support coming out or markets fall far enough that it doesn't matter.
Yeah. I mean, the basic notion, I guess, is markets need to push policy.
Exactly. Yeah.
So,
They won't.
We're looking to buy that inflection point.
But we're not there yet. We're still
No.
No. Okay, I might leave it at that, Mark. Unless there's any, I don't know if there's any other questions.
No, there don't seem to be any other questions here. We'll just go to the question of the week. And my apologies to the viewers. This should have been reworded a bit. I guess what we're trying to ask here is, do you think that wage inflation is at a new normal, or is there potential for wage inflation going forward? Do drop your answers in the comments, and we'd love to hear from you. And just once again, gentlemen, thank you for your time. Thanks again to our viewers who have watched this episode live, and to all of you who have asked questions along the way. I hope you've taken away a few points to ponder, and we welcome your feedback on the show. Once again, don't forget to click like on the video now. And finally, if you know someone who might get something out of today's episode, do share this with them. And if you'd like to see more of our content, head over to Nucleus Wealth /content, where you can see our previous webinars and stay up to date with news from us. Follow us on the various social medias. Thanks again for turning in. And for myself, Mark, and the rest of the team, look forward to catching you next week.